Hey everyone, welcome to another week of Loom videos, free training. My name is Warren Howe and I hope you're having a great day out there. Yep. Now, so today we're going to talk about forward PE ratios, right? And a little bit about what to look at instead of just forward PE ratios. What should we be mindful of? And, what are the strategies moving forward when it comes to positive forward PE ratios from a negative losing money, stock. Now, over here we have Dropbox, and by the way, this website, if you guys don't know, it's an awesome website, because it's everything on one page. We have literally all the ratios, right? Not all, but most of the ratios, telling you from how much is the market cap, income, sales, employees, PE ratio, forward PE, PEG ratios, and whatnot. All of this, which we have talked about in our free weekly trainings, right? I go live every week on Facebook. Yep. So do check it out. We do actually have our lives there, and I talk about financial ratios. We feel free to chime in on any sort of a topic that you want me to discuss on, right? So a little bit about forward PE. This is Dropbox, okay? This is a website, Finviz. I think only encompasses US stocks, right? I mostly use it for US stocks. Now, what do you do when you have a forward PE of 19? Okay? Now, what do you do? And what does it tell us? First of all, having a negative PE, like if a company loses money, you will see a blank PE right here, right? So what does that mean? It means that they have lost money. That's why you can't even record a PE ratio, right? But this is the importance of actually digging into their income statement to actually find what is the reason that they are losing money, right? So just a short one, a short answer to that is that Dropbox realized a sort of impairment, real estate impairment loss, something that I've been sort of talking about on Dropbox in my lives. So they have this real estate impairment in their income statement. So that's why you see them, having a negative balance, income statement, right? Losing money at the end of the day. But actually the operational, business, they're actually profitable, right? On the operational income. So that's number one. Do not entirely trust, websites that tell you that they're losing money, right? So always find out their balance sheets, from the 10Ks, from the 10Qs. Always get updated on their income statement, because what is the real reason? Are they really losing money operational wise? Are they not? Because this impairment is not a cash charge, right? It's basically it has nothing to do with the operational efficiency of the company, right? So that's number one, the profitability of the company. So that's number one. Number two is what does it mean when a company has a forward PE of 19 from a loss-making company? Well, first of all, it's a very sexy story, right? It's a turnaround story because they were not profitable, and obviously projected to be profitable by next year. So forward PE means that we are encompassing the current market cap, right? Simple terms is the current market cap, which is 11.9 billion. They are expected to grow earnings and be profitable 4 quarters later, right? A year later from now, which will bring their earnings up, and the current market cap still remaining at 11.9 billion. Yep. In other words, if we take 11.9 divided by the forward PE, we would get the amount of earnings it would take, for them to reach to a forward PE of 19. So imagine this: next year, 12 months from now, imagine that their market cap will still be the same, which is 11.9 billion. Yep. The company will have to earn 631 million for them to have a PE of 19. You see what I'm getting at? So where do they get this 19? It's basically, from all the analysts. Yep. They are projecting, a very favorable earnings for this company, because in the last quarter earnings, if you have been updating on their Q2, you will see that the net profit, the net income that they have is 88 million. right? If I'm not mistaken, it is 88 million. Now, if you were to analyze, just a simple calculation, you were to analyze 88 million, that would just bring you to, 300 plus million. So a 631 million is in fact very positive, right? Very, very positive. So what is the takeaway here? The takeaway is, what would you do if you see a company that is profitable FPE wise? Yep, especially 19, right? From probably a 200. I worked it out. The trailing 12 months PE is close to, around 200 to 300. Now, what would you do if it's a current PE of 200 to 300, working forward PE of 19? That's number one. Number two is, would we buy the company even if they reach a PE of 19 1 year later? Would we buy it? Now, obviously, there are a lot of factors involved before we decide whether we want to buy or not, right? We have to take into consideration their growth plan, their qualitative analysis, but this is something to think about. If you see a company losing money and having a forward PE of 19, the thing is we need to fact check whether or not we should trust the analyst, right? What are your own projections is it overestimating things, or is it underestimating? Is it sandbagging? Yep. So hope you got some value out of this today. This is something to consider when it comes to forward PE, and I'll see you in the next video.